Welcome, today we'll be doing another stock tier list, but this time we'll be reviewing companies with very wide moats. Now, before we get into it, I have a small disclaimer, which is that you may not agree with a lot of these companies, and I may be missing other companies. If you believe so, leave the name of the companies down below so I can do a part 2 of this series, or if you have any other ideas of future stock tier lists, just leave them down below. We're actually going to be ranking these companies by two different factors, the first one being how wide their moat actually is, and the second one being how strong their fundamentals are. Starting with none other than the king of investing for the last couple of decades, which is Apple. Now there is no mystery to what wide moat this company has because they first of all have created a brand image and a sense of luxury or exclusivity among their products that almost everyone wants to own their products. I'm sure that there are a lot of companies which have so many products with a lot better characteristics, yet Apple is still the king when it comes to the iPhone and to the MacBook. However, when we move into their fundamentals, they're currently priced at a hefty 38 price to earnings ratio, with their revenues being at the same spot where they were in 2021. I will have to put it as a B tier just because of its valuation and its low revenue growth. Next on the list is Adobe. And this is a fun one because there are a lot of people who believe that they do have a very strong competitive advantage, but there are a lot of people who believe that they don't have any competitive advantage at all. Most corporations still work with Adobe's products. However, they have been so profitable for such a long time period, and now with AI coming into play, a lot of small competitors are actually chipping away at their market share slowly but surely, which means that they're actually managing to break down their competitive advantage and their moat, especially because their products are not cheap at all. They're currently trading at a price to earnings ratio of 37 times, but the thing is that this company is growing at a pretty fast pace, with the revenue growth being over double digits ever since this company actually started operating. However, we can see some sort of trouble that this company has been having just by the decrease in margin it has had from 2020, where their margins were closer to 41% and they're now all the way down to 25%. If this goes on, it could be very worrying. I will have to put it in the C tier. Next we have Amazon, which is an extremely easy stock to rate. It's a must buy. This company has one of the widest moats in every single industry it operates. It is the leader in the cloud segment, it is the leader in e-commerce, it is one of the leaders in streaming services, and every single one of their other smaller initiatives, they're starting to dominate and they're disrupting the different industries. This company's revenues have been growing at double digit as well for a very long time. However, one of the positive things that this company has is that their net margin has been expanding consistently. If we look at 2022, they had a negative 0.5% net margin, but nowadays in 2024, they ended the year with a 9% net margin, and this is rising consistently quarter after quarter even this year. The only worrying thing about this company is that they're trading at a price to earnings of 42 times. However, being such a high quality company, having such a wide moat and such great fundamentals, it might be worth to pay that for Amazon. Next on the list is Asml, and I'm not going to lie to you, I'm not very big into all of this technology industry, so I am a bit lost when trying to analyze these companies. I do know that it gives support and machinery that is needed for the semiconductor industry, which are called lithography devices. Now these devices in theory are used by all of the different semiconductor companies in order to create their products. And when one of these companies wants to renew their lithography machines, there are very few options as good as Asml. Having said that, this company trades at a PE ratio of 37 times, but in 2024, their revenues only grew by 3%. However, there are many people saying that this is just a bump in the road, and that this was being caused by companies actually wanting to buy these machines further in time, meaning that the orders and the demand for their lithography machines and this revenue will arrive later in the decade. Now, since I'm not an expert in this field, I cannot judge whether that is true or false. However, it does raise some questions for me, and I do have a bit of uncertainty with this company, so I will place it right behind Apple. Next on the list is Booking Holdings, which is the clear market leader in the tourism industry. I have seen many people actually confused and wondering whether this company actually had a strong moat or not. I personally believe they do. They have an amazing network effect, especially in Europe where they're the biggest competitor by far. And it's gotten to the point where if you run a hotel, it's very hard to actually get by if you don't have it listed on Booking. And there is no other competitor like this, and I should know. I've thoroughly looked for hotels in every website I can find, and I almost always end up on Booking. Now, despite only having a price to earnings ratio of 33 times, In 2023, they had a growth rate of 25%, and they have had an amazing growth rate ever since the pandemic in 2020. And this, of course, has been done while improving their net margin from a 1% in COVID all the way up to a 20% in 2023. I am a proud shareholder of this company, and to me, it is in the A tier. Next, we have Costco, a retailer which I'm sure needs no introduction at all. One of the main moats from this company is, of course, their service. They provide such excellent service and have such a great price to quality for their products that everyone is super attracted to them. And despite them always having this sort of competitive advantage, they have managed to increase it over the years by the creation of their membership. And this not only makes it so that their clients are potentially fully subscribed to the Costco experience and never purchase anything in other retailers such as Walmart, it also brings in a very consistent and predictable source of revenue for them. However, I do believe that this company is highly overvalued, as they have a price-to-earnings ratio of 63 times, but in the past 2 years, they have grown their revenues by 6 and by 5%. Next is Canadian Pacific, and this company basically operates trains. They carry out freight transportation using railroads. And when you think about railroad companies or train companies, these have extremely high barriers to entry. First of all, trains are extremely expensive to manage, but second of all, there is a limited number of trains that can actually go around the country. If you look at the top companies which are currently operating train transport, if you look 30 years back, there is a very high chance that you will see the same companies on the list. Having said that, this company currently trades at a 28 price-to-earnings ratio, while their revenues grew by 7% last year. Their margins have actually fallen from a 40% in 2022 all the way down to a 25% last year, and this raises big questions about the sustainability of the company. In my opinion, Canadian Pacific goes into the C category despite having a very wide moat. Next on the list is Copart, and for those of you who don't know it, they basically engage in the provision of online auctions and vehicle remarketing services. So if you get into a very bad crash and your car is totaled, or if your car doesn't run anymore, you can sell it to Copart, they will give you a little bit of money, and then what they will do is that they will place it in their own auction site or even remarket it in another way. And the thing is that Copart has become extremely good at this, and their moat actually comes from them being extremely large to the point where they have a lot of agreements with different insurance companies and different large fleet management companies in order to buy their used cars at very low prices. But additionally, it comes from this industry not being sexy at all, so it is very unlikely for this industry to be disrupted, which makes Copart have an extremely wide moat. Now, this is why this company currently trades at a PE ratio of 42 times, but the revenue has been growing at over double digit for the last couple of years. I would be extremely interested in actually owning Copart, I just still haven't done the correct research, but I will classify it as an A tier. Next on the list is another one of my holdings, Salesforce, which basically runs cloud-based enterprise software in order to help companies. And you can do a little bit of research, but you will find out that Salesforce is used by almost every single company in the Fortune 500. Now, I wouldn't say they have the strongest moat in the world, because there are a lot of services which are very similar, but due to their size, where they can offer better prices for clients, and you can actually believe that their product will be of high quality, you can see why most clients actually choose to go with Salesforce. Now, when we look at their annual revenue, it has been growing by over double digits for as long as I can remember. And the fact is that recently they actually stopped worrying so much about their top line growth, and they decided to focus on expanding their margins, which can clearly be seen by their margins in 2022 going from a 1% all the way to a 12% the following year. Their fundamentals are extremely strong, but due to their moat not being as high, I will have to place it in the B tier. Next we have Disney. Disney needs no introduction. Disney has an incredible image where everything they produce, every single movie, every single new amusement park will get a lot of attraction because you know it's Disney. It's basically part of our culture. However, there are a lot of problems with this company. In my opinion, their movies just haven't been standing out recently. Most of their movies have been disappointments or just remakes of older movies. I believe that Disney is lacking direction, lacking proper management, and lacking a lot of that creativity spark that actually created this business and made it Disney. Because of that, this will be the first company that I place in the void. Next we have Fico, which is the heart of the American credit institutions. They're basically a software which helps banks decide what interest rate they should give you and if they should actually give you a loan or not. They have been managing to increase their prices year over year in an extremely aggressive fashion without any of the banks actually managing to find a separate solution. So it goes without saying that they have an amazing moat. However, it's gone to a crazy point where their price to earnings is currently 83 times, and their revenues have been growing between 5 to 10% for the past 4 years. Does that growth actually command an 80 times price to earnings multiple? I get that this company has one of the most unique business models in the world and has a very wide moat. However, when you consider their growth potential, they can only grow via price because almost everyone already uses them in the US, and I don't believe that they have an option to expand into other countries because the financial institutions in the US work in a totally different manner than the financial institutions elsewhere in the world. So just because of that, I will have to place Fico in the C tier. Next is Google. And how can you doubt a company like Google having a very wide competitive advantage? This company is actually becoming better at everything they do. They're also in the cloud segment. They're currently developing a lot of different technologies and in their other bets segment, such as Waymo, which is in the autonomous ride-hailing segment and is already becoming an important part of Google's top line. Additionally, when Google is in loads of antitrust trials, how can you argue that they don't have a competitive advantage? The only thing, however, is that these trials have actually created a lot of uncertainty around this stock, which is why, despite being such a high-quality company, it currently has a price-to-earnings multiple of 23 times. This company has managed to grow their top line by over double digits for a very long time. And additionally, they have managed to grow their net margin from a 21% in 2022 all the way up to a 30% in 2024. However, due to their uncertainty, I will have to place them in the B tier. Next is Mastercard, and we can always review it at the same time as Visa. Only these two companies are responsible for processing the vast majority of payments that occur every single day around the world. And they're also being prosecuted for antitrust trials, both of them, because it is believed that their commissions are extremely high and could be a lot lower, but they're not because they're abusing their monopoly power. And when you look at the margins of these two companies, they're both over 50%, so they're doing just fine. Having said that, these two companies are very predictable. They don't have big shocks, their prices just keep going up quarter after quarter, and they're always surprising earnings and beating estimates. So having said that, these two companies go in the A tier. Next is Meta. Well, this company I believe has a very strong moat because practically everyone in the world uses WhatsApp, Instagram, or any other of their services. Of course, you could argue that their competitive advantage is being placed at risk by TikTok, but I don't see TikTok as a substitute to Instagram. Each one is unique in their own way. And the fact is that this company fundamentally is a monster. Despite only trading at a 30 times earnings, they have managed to grow their revenues at a 15% and 22% in the past 2 years. And all of this while growing their net margins substantially, going from 20% in 2022 all the way up to 38% in 2024, almost doubling it in 2 years. I personally fail to see any growth avenues or other growth potential that this company may have, but seeing as they have managed to grow their revenues at such a quick pace due to advertisements primarily, I will have to put this company in the high B tier. Next we have Microsoft, which I like to call the forgotten stock of 2024, because it has traded down by 3% in the entire past year. While in 2023, this company was one of the top performers. This company is used by almost every single corporation, it's one of the leaders in the cloud segment, and it has a lot of growth avenues going forward, especially in the AI field and the data analytics segment. And there is no wonder that this is one of the most recognizable and best companies in the world, which is currently trading at 33 times earnings. I don't believe we need to explain their competitive advantage because their products are used by almost any corporate in the world, and there is a reason for it. They're the best at price to quality, and they have such a good name that companies directly go to them before even considering other options. Now in 2024, their stock may not have moved a single bit, but their revenues rose by over 15% in 1 year. Now their margins are extremely consistent and have sat above 31% every single year since 2019. This company is clearly a must-buy. Next is Netflix, and this will easily go in the must-buy category. Now this company has an incredible moat, it is the leader of the streaming services category, and the thing is that they're currently expanding into other segments. They're now starting to broadcast streaming sports, and they're even offering games. What Netflix has is extremely special, because they're increasing their users year after year, these users have a super high retention rate, and Netflix has been increasing the prices year after year after year, and surprise, almost no users have actually left the platform. And that is why this company is up over 85% this year. trading at a price to earnings ratio of 52 times, with the revenues rising over 15% in 2024. The only issue, of course, is their valuation is extremely high. Next is Nike. This company is down 30% year over year, and they're currently trading at a price to earnings ratio of 22 times. In my opinion, this company does not have a wide competitive advantage. In sportswear or any other type of fashion wear, it is very hard to actually create competitive advantages. Because if you stop innovating, you stop delivering premium quality, and you stop focusing on your clients, you will lose all the success you gained, and Adidas, Puma, or all the other competitors will start to slowly chip away your market share, and you will find yourself in a position that is very tough. In my opinion, since this looks like a turnaround for Nike, I will place it in the avoid category, because I don't like to participate in these. I myself like to place my capital in places that have higher certainty and predictability. Next in the list is Novo Nordisk, the European giant, which is down over 30% this year. Now, since this is a healthcare company, their competitive advantage can come up in two ways. First of all is their size, because they can spend a lot more than their competitors in developing new pharmaceutical products, and the second one is through the patents that they may have with their existing products. And now, a patent is the clearest way of competitive advantage, because it means that you and only you can produce and sell that product. Having said that, this company currently has a price to earnings ratio of 24 times, and it grew their total revenue by 25% in 2024, with their net margin decreasing from 36% to 35%. So a very good year overall. Looking at this, it looks like their fundamentals are rock solid, but I have some doubts regarding their competitive advantage. Next is Philip Morris, and yes, that is a tobacco company, which is usually supposed to be extremely stable. However, in 2024, their stock is up over 60%. This company, despite me not liking their product at all, has a very wide competitive advantage, because they have their clients addicted to their products. Additionally, they have improved their competitive advantage by releasing their newest products, the IQOS brand. This, in theory, is a substitute to smoking, which is healthier, or so they say, where you need to buy a specific machine in order to smoke those new tobacco products. Now, before that, you could go to a machine and buy whichever tobacco product you wanted. Nowadays, if you have the Philip Morris or the IQOS machine, you can only smoke IQOS-specific tobacco products, which has made their moat a lot wider than before. Their price to earnings currently is around 33 times, despite their revenue growth only being at 7% in 2024. They're doing the right things, and they have a very wide moat, but I believe their fundamentals are a lot weaker than most companies over here. Next is Starbucks. And before you say that Starbucks doesn't have a wide moat, how many people in the world actually decide to buy a coffee or food at Starbucks rather than go to a local cafeteria? Well, they're currently trading at a market capitalization of $130 billion. So that means that a couple 100 million people prefer to attend Starbucks than to go to their local cafeteria, which would be cheaper and probably tastier. But this is because of their brand and the quality of the service that they have managed to deliver year after year. They're currently trading at a 36 price to earnings ratio, with their revenue growth rate being very stagnant. At the end of the day, this is a turnaround play. And you know what we think about turnaround plays. Next is S&P Global. And this company, you can divide it into all of its segments, but you can focus mainly on two. First of all is their credit rating agency, and second of all is their data and analytics segment. Now, when companies want to issue bonds or issue new debt, they have to rate it in order to get better conditions. Who rates this debt? Well, there are very few companies. However, S&P Global and Moody's are their largest ones by far. And the thing is that investors usually look for credit ratings which are being carried out by legitimate and trustworthy businesses, where one of them is actually S&P Global. However, this company is a bit pricey, trading at a price to earnings ratio of 44 times, with the revenues growing by double digits ever since 2019. Additionally, this company recently improved their net margin from a 21% all the way up to a 27% from year to year. So I will have to put this company in the B tier. Next is the Taiwan semiconductor company. As I stated previously, I'm not a huge expert on semiconductors, so don't trust me too much on this rating, but from what I've heard, this company is the clear leader of semiconductors. They produce the vast majority of them. Their moat mainly derives from, first of all, their size. They can generate cost advantages for their clients, and on the other hand, they have such a recognized and long-standing name that a lot of companies trust their products and know that they are legit. Their price to earnings ratio is currently 29 times, and in 2024 they grew their revenues by 30%. All of this while growing their net margin from a 39% to a 41% in 1 year. Not a bad company at all. However, since I know so little about this company, I will have to place it in the B tier. And last but not least, we have another one of my holdings, Uber Technologies, and despite this company being one of the clear leaders in the ride-hailing industry and in the food delivery industries, I do understand people that say that this company does not have that wide of a moat. There are so many options, and when you're looking to get a taxi or to order food, rather than the company you're actually ordering it with, you care about the time that it's going to take to get to your destination or for the food to arrive, and for the price. And currently there are so many options in the market that it's hard to just pick one and be loyal to it. I do believe that Uber is building a very wide moat. As it's trying to leverage its network effect, it's offering a lot more services than its competitors, and it's becoming like the transportation super app. You can now book train rides, you can access car rental services, and you can even access autonomous ride-hailing services from all of their different partners. And in terms of fundamentals, this company is only trading at a price to earnings ratio of 17 times. However, in 2024, they managed to grow their revenues by an 18%, with their margins increasing from a 5% in 2023 to a 22% in 2024. And of course, they're still growing them in 2025, which is one of the main reasons why I actually started owning Uber, and because I am a big believer of their future. However, I understand that currently they don't have such a wide moat, so I will have to place them in the low C tier. If you got this far into the video, thank you so much, you're a legend. Remember to comment down below any other videos that you would like to see, and thank you very much for watching. As always, this has been the Cashflow Compounder. I'll see you on the next one.